Hey, I welcome you to this technical analysis part one session. Technical analysis is a very vast subject. It will take years and years to learn and master the subject. I'm not going to bore you with the entirety and too much of academic interest. What I'll be teaching you is purely practical, which you can, it's the nuggets. I'll break it into bits and pieces. I'll make this into interesting nuggets. I'll share it with you, and then, which you can implement which you can directly implement and see the benefits for yourself. So I welcome you to this part. So first of all, the first concept which I would like to give you in technical analysis is price action trading. So what do you mean by price action trading? Here, price action trading is a method used uh, using the historical price points to help making trading decisions. Okay, like what do I mean by this? Like usually when people trade, how do they make their trading decision? People make their trading decision based on somebody told me, yeah, somebody gave me this advice, my neighbor told me, I read in a newspaper, I saw on a TV. These are some of the things based on which people make their decision to buy and sell stocks in the market. Whereas in technical analysis, it is always about a particular price. That's called a price action. What are you going to do at that particular price? I'll simplify it. What do I mean by it? Like, sometimes the stock might not look attractive at even 100 rupees. Suddenly, it might become excessively attractive at 108 rupees. Isn't it expensive? Is 108 not expensive than 100 rupees? How come people are more interested to, buy at 108 and not at 100? That is exactly being answered by the price point. That is where the whole lot, or whole world would like to buy that stock at 108 and not at 100 rupees. That's precisely what exactly a price action means. At a particular price, people would like to, bring in action to that stock. It could be buying, it could be selling, anything. Now, how do we make this? It's based on some of the parameters like open, high, low, close. These are the important parameters. What do I mean by open, high, low, close? Open, what price, where as soon as the trading starts, what price it opened, and whatever might be the time frame. Like now when we are looking at time frame, it could be 1 minute, it could be 5 minutes, it could be 10 minutes, or hourly chart, or whatever. When we are looking at a particular, what is the time frame, what price it opened, what was the high during the period, what was the low it touched during the period, and where did it close? I'll give you a simple example. 9:15 the market opens, and then as soon as it opens at 100 rupees. For simplifying examples, I'll usually use 100 rupees as a mark so that it's easy for us to understand. Let's say a stock opens at 100 rupees, and between 1 and 1.5, it's a 5 minutes chart. During that time, it actually goes up to a high of about 104 rupees. Meantime, it even rallies and slightly comes below, 98 rupees it comes. And then at just about 920, exactly, 919 and then 920, it manages to close at 102 rupees. So this is how actually it is tracked. Opened at 100, went up to the high of 104, came to the low of 98, but closed at 102. Now, what is this trying to tell us? Is what we are going to understand. This is how we are going to understand, the open, high, low, close of a particular time, whatever time frame we are looking at. These are the important parameters based on which the decision to buy or the decision to sell it will be made. Now, let's move to the next slide and understand much more about it. Usually in a bar graph, we clearly know how this is how traditionally until the Western world learned about candlesticks, they predominantly used bar graphs or bar chart. And this is how exactly a bar chart looks like. Simple, you draw a line and then you start marking. Whatever to my left, whatever is towards my left is basically that's where it opened. And then what was the high it reached? What was the low it managed? And then where did it close? Based on which now when they started filling this in color, it started becoming candle. Until then, this is called as OHLC bar. So price action is a method of using historical price points to help making trading decisions. Following parameters were used like open, high, low, close, which we saw exactly, exactly now. Now let's try and understand what is this price action. Now, typically people take their decision based on some announcement which is actually coming in the television, based on whatever they're reading in the newspaper, based on what somebody is trying to tell. So all these news is actually history. It's very old news for the for the stock market. Yeah, even before I and you come to know, actually stock market would have already got the message. That's where the already the volatility or the movement would have happened. By the time I and you come to know about the news, the market has already reacted. We would have already seen its reaction. Have you noticed it? Usually, you just wait for the results of a particular script of Infosys. 11 o'clock, the Infosys, results are going to come. They announce of, splendid result, and then you have seen the stock tanking about 2-3%. Whereas you would have seen in the last 1 week, the stock would have gone up by 7-8%. This is in anticipation of a good result. And then once the news is out, we would have actually seen the correction taking place, which means the market has already factored the news. So if you are a news based trader, it is time to change. So you should be a price action trading, whatever is the price trying to tell, based on the psychology of the group. We are going to cover more about psychology of the group. Based on the psychology of the group, you need to make those decisions to either go with the crowd, or you have no other choice but to go with the crowd, whether you want to buy or whether you want to sell. Now let's see how exactly it works. So what do I mean by that? Let me tell you a brief history. Typically the Western world, the American world, mastered the bar graph, which had a simple line OHLC, which was marked. Whereas much ahead of that, in Japan, particularly in Japan, they had something called candlesticks, and they used to even color the candlesticks. These are nothing but basically they're trying to capture the entire psychology, which I'll be talking to you a little later. But now I'm going to just briefly tell you whatever. I'm going to repeat what I told you about price action trading. So it's a method, as I told you earlier, uh, using the price action, using the based on whatever is the price currently, what is the emotion behind it. If you think, the whole, there will be a whole lot of buying which is going to come, then people buy for it. And then if you think there is a sales pressure which is going to come, then you might have to end up and sell the stock. Yeah, or trade in that direction. Now, this is how a candle will typically look at. As you can see here, whatever is the opening price, and here, why is it in red? First of all, the open and high is same, and then it went low, but it managed to close slightly above the low. This is how a bearish candle will look like. Let's look at a bullish candle. It opened low, open and low are same, and then it went up to a particular high, but it managed slightly closer below. That is called, you can call it a wick, or basically, or a tail, whatever you can call it out. The close is below the high. Since the close is above the opening, the color is green. If the close is below the opening price, then the color is red. These are the simple rules of a candle. Now, this explains a simple rule of candle. Now, basically, now I'll come to a point. I'll be talking about now period. What period is it measured? What is that periodicity? Now it can be tick by tick, like every tick. There can, of course, there is a live stream of information which actually comes from the market, but it can be tick by tick. We can have a 1 minute chart. Now in this 1 minute, whatever is the open, high, low, close is also measured. And then there can be a 5 minutes chart, 10 minutes chart, 30 minutes chart, hourly chart, daily chart, weekly chart, and monthly. Now here, let me tell you, what if I have to study this market for a long enough period? I would like to watch the 2008, 2009 fall. I also would like to see the 2000, what happened in the market around 2000, what happened in, earlier to that. Then I would probably look into a monthly chart or a weekly chart or a daily chart. So when I'm looking at a short-term chart, maybe a minute or a 5 minutes chart, basically my vision will not be for beyond next 30 minutes, whatever can happen in the next 10 minutes, next 15 minutes, next 30 minutes. if my view is narrow, I'm just looking at next 15-20 minutes, then I would definitely go by a shorter into period chart. If I'm looking at I'm not looking at doing 2 minute trades in a day, but I more or less I want I want it to be an even out. I want to put place maybe just about 1 or 2 orders or 3 or 4 orders in a week. I would probably look into a 15 minutes or a 30 minutes chart. So this is how exactly I take, based on which I take my decision. Now, this is something like you would have gone to the soothsayers, you would have gone to people who actually are in the business of prediction. Now, it's like, they look at a 5 minutes chart and they try to say, the market is going to go up by another 1,000 points. So I'm not saying they're wrong, but there is some mismatch here. If you really want to predict such long term goals, if you really want to see some big movements, then definitely it should be the longer period of chart you should be looking. If I'm looking at probably an hourly chart or a daily chart or a weekly chart, then I definitely know what can happen during the year, what could be the range during the year. If I'm looking at a 5 minutes chart and if I'm predicting what's going to happen for next 1 week, it could as well be a joke. Yeah, so that is how you actually choose. Based on your intention to trade, you actually choose the time frame. Now, once now that we have understood what exactly is a price action at a particular price, we take action whether to buy or to sell the stock. So which is not based on any news, which is not based on any information. This is purely based on the price. And then the period at which the historical price is always measured in the period. So we are going to look at the period. Now, what is a good period? Now, this is where I'm actually coming to. Now, look at what I'm trying to say. This is the Western methodology of OHLC. The same, this is how it would look in a Japanese candle. Yeah, so the closing is much higher than the opening, and we saw the high going up as well as the low. Now all this is measured. Now basically this also measures the sentiment of the trader. Now this is collectively whatever might be the volume of trade it would have happened in that period, whether in a minute chart or a 5 minutes or for 10 minutes, whatever the trading would have happened in that period. Now what is this emotion? What is this? We are going to understand now how actually Japanese excelled in learning about the markets is about trying to capture the emotion of the traders. Now let me give you more examples of that. Yeah, this is how exactly it looks like. Now the same thing, how would it look in a line chart? Now here these are the two examples, and where how it would look in a line chart. And this is how exactly what you can see here is the Japanese candle, and then here is the open high low close chart. Yeah, when you do it in sequence, now what happens when you measure it for a continuous period, then you can actually see it in a sequence. Now even individual what should I say, even an individual bar or an individual candle actually tries to tell a lot of stories. It captures a lot of emotions of these traders who actually make the decision to buy sell. Yeah, so this is how exactly it looks like. The market typically, this is how it looks like. Yeah, market movement. Then when you put it in a line graph, this is how there might be a movement like this, but when you actually put a candle, it could be very simple. It could be a very simple candle like this. It can be any of these. The movement can resemble any of this. It might have intermittently a lot of ups and downs, but what point it opened, what was the highest point during the period, what was the lowest point during the period, and where did it close. These are the the important information which is actually collected in a candle. Now there can be gaps. If there is a difference between the closing price of that period and then the opening of the next candle, there can be gaps too. I'll give you a simple example. Exactly at a 5 minutes chart at 9:20, a particular stock is trading at 100 rupees 80 paise. The very next second, the stock will trade at 101 rupee 40 paise. Now there is a gap. So that gap is also shown here, which is important to ascertain the strength of the stock or the trader's mentality, whether it can be an upward gap, there can be a downward gap, but that gap, understanding the gap is also important. Yeah, there are some ground rules about what should be the gap, what kind of gap, all those things. We will get into it as we go ahead, but I'm just trying to introduce you to some of the concepts. Now that we know that even a single candle actually is an expression, like a long green candle, which means bullish sentiment. There are people who opens low, and then even until here, the only buying, the closing is much high, at a higher level, which shows the strength in the market. If there are twigs on top, which means it went high but it could not sustain, it came down, which is trying to say there might be some selling pressure. There might be, similarly, there is a twig at the bottom, and then it has bounced back, which means that there was a selling pressure, but market bounced back. So all these are actually, we are getting a picture. Are we not getting a picture? When we are talking about, you see one candle, it actually expresses the whole sentiment behind it. Now, some of the patterns, we will be going more, we'll be talking more about the patterns, but I would just like to mention here, one of the most famous, or most of the trend reversal happen usually. What we are most interested when we are actually watching candles is a trend reversal. So the most commonest we find is a harami cross. What do you mean by a harami cross? Yeah, here, as you can see in this example, it's very clear. Yeah, actually there is a strong green candle. Then there is actually something which resembles cross. I'll come to that. That's a doji. And then there is a bearish candle. The current candles range should be completely engulfed by the previous candle body. So it's completely covered. The size of the second candle affects the magnitude of the reversal. Then actually it doesn't matter what happens. It is not just one candle. We try to understand the emotion, the follow-up candle, and we must wait for the next candle to confirm, which means if there is a counter signal, if there is a candle and then there is a counter signal, the next candle will decide, will confirm the movement, or it can be a fake call. So follow-up action is most important. The follow-up here, I would like to tell you in the second example. In the second example, what happens here? There is a bearish candle, then there is a doji, then the follow-up movement, the green candle is above the previous doji, which actually confirms a trend reversal. Similarly, in the first example, as you can see, the moment is bullish. There is a bullish movement, there is a green candle, then there is actually a doji. The follow-up candle is bearish, which is below the opening of the previous two candles. So obviously there is a trend reversal. In Japanese terms, harami just means pregnant. The candlestick signifies trend reversal. Basically, there is a change in the trend. If the market is going in a bullish pattern, there could be a small change. It denotes, it's something, it looks like a pregnant. Yeah, the body in the middle, suddenly there is a piercing. Actually, there is a piercing, and suddenly the body is swollen in the middle. Yeah, but the confirmation is required. The follow-up candle is required typically. Yeah, this signifies trend reversal. So there will be more as we go ahead. I'll be having more examples, even on a live situation, showing you what exactly is this. So here I would like to talk about some of some of the patterns. So we know that right now, we know that a single candle denotes the emotion, collective emotion of the people. The group of candles actually decides what exactly is the emotion, the confirmation of the emotion. Yeah, is it in trend or is it against the trend, is what you're going to see. Now, this is how in a real world, the actually the thing is going to look like. As you can see here very clearly. Yeah, the example is very clear. As you can see, there is actually a piercing above. There is a strong bearish candle. There is a strong bearish candle, and the follow-up two candles had a pierce upwards, which changed. This is actually a daily chart, which is a real chart. And then you had a similar action, which is happening here. A similar action, which is happening here. There is a small gap. There is an uptrend, which is actually broken by a harami, and then follow up by fall. This is how it exactly looks like. Uh, First, what I would like to share is actually, in the academic interest, I'll share with you the concepts. Once I share with you the concepts, most of the concepts, and then I'll be actually taking you on a live screen, and then I'll be showing it to you how exactly it looks in a real time.